I do apologise, everyone, for the slight delay then just getting started. So it's myself here again, Noel Hillman, joined with Adam Aderton, the Chief of Investment Division's Asset Management Unit of the SEC. Morning, Adam. How are you?
I'm well. How are you, Noel?
Yeah, very good, very good. Well, Adam, I'll pass over to yourself now to get underway with your presentation. I'll be here in the background for when the presentation is over and any questions that we might have from the audience. I'll be back soon. And Adam, over to you when you're ready.
Thank you so much. Good morning to those of you in the U.S. and good afternoon and good evening, depending on from where others of you are joining. Thank you, Noel, for inviting me to speak at the ClearPath Analysis North American Institutional ESG Investment Summit, held appropriately enough just a couple of days before Earth Day 2022. And before I continue, I must give the standard SEC disclaimer that the views I express today are my own and do not necessarily represent the views of the Commission or its staff. So with that piece of housekeeping completed, I'm so happy to be at this very timely conference today to talk about an issue that's been receiving a lot of attention at today's SEC. In my remarks today, I plan to focus on the SEC's recent efforts related to environmental, social, and governance issues. I'll start by explaining where I sit in the SEC and how my position influences my views on ESG issues. Second, I'll talk a bit about the Commission's historical approach to ESG investing. Third, I'll touch on some of the reasons why I think these issues are so central right now. Finally, I intend to use the majority of my time today to talk about what various groups at the SEC are saying and doing about ESG right now. At the conclusion of my remarks, I'll be happy to take some questions. First, I want to talk a little bit about my role. I'm currently co-chief of the Asset Management Unit in the Division of Enforcement. In this role, I lead a group of enforcement attorneys who specialize in investigating potential misconduct by investment advisors, including advisors to private and registered funds. So I act primarily to help the Commission in enforcing relevant statutes and rules, rather than making those rules in the first instance. I'm also a member of Enforcement's Climate and ESG Task Force, which, as I'll discuss more later, was created roughly a year ago to develop initiatives to proactively identify ESG-related misconduct. In particular, I and others on the task force focus on disclosure and compliance issues relating to investment advisors' use of ESG strategies. Now that I've explained where I'm coming from, I'd like to talk a little bit about what the SEC has historically done with respect to ESG. I begin by noting, as many of you are probably well aware, that interest in ESG issues is not new. Some significant number of investors have been interested in climate and ESG for decades. As early as the 1970s, some asset managers began to integrate ESG factors into funds with social and environmental investment objectives, while the early 1990s saw the launch of the first socially responsible indexes. Since the mid-2000s, many financial institutions have signed on to various climate and sustainability-related frameworks. And wherever investor interest and ultimately investor assets go, the SEC is sure to go along. For example, all the way back in 2008, the SEC brought a settled enforcement action against an investment advisor called Pax World Capital Management, charging it with violating investment restrictions in socially responsible mutual funds that it advised. Specifically, the Commission's order found that the advisor purchased at least 10 securities that the fund's socially responsible investing restrictions prohibited them from buying. The order found that these purchases were contrary to representations made both to investors in the funds and to the fund boards who supervise the funds. In announcing the action, the then enforcement director put it quite well, saying, advisors simply cannot tell investors they are going to do one thing with their funds and then not follow through on those promises. This is particularly true with respect to socially responsible funds because their stated investment restrictions are likely the primary reason an investor chooses to invest in these funds in the first place. The then enforcement director hit on what is really a fundamental principle with respect to investment advisors' use of ESG strategies. When an advisor purports to adhere to a particular strategy, they must follow through on the promises they make to investors regarding that strategy. Because, as is the fundamental bargain with respect to the SEC disclosure regime, investors are entitled to full, accurate disclosure so that they can then make an informed decision about what to do with their assets. And the action wasn't just on the enforcement side. Historically, the SEC has taken a role in public disclosure as well with respect to ESG factors. In 2010, not long after Pax World, the Commission issued its first interpretive guidance to public companies regarding disclosure requirements as they apply to climate change. This guidance, now 12 years old, walks through several of the common SEC filings by public companies to discuss the application of certain climate change matters in those disclosures. Both Pax World and the 2010 guidance are some indication that the Commission has been interested in ESG investing as long as investors have. But since the time of Pax World and the initial public company climate guidance, investor interest in and assets allocated to investment strategies that consider ESG factors have exploded. U.S. sustainable investments increased to more than $17 trillion by the end of 2020, including a 42% increase from 2018 to 2020 alone. And asset managers have responded to investor demand by creating and marketing funds and strategies that consider ESG factors in their investment selection process. And investment advisors have done this at an astonishing pace. A record 71 sustainable funds were launched in the US in 2020, only to have that record shattered in 2021 with the launch of 121 such funds and another 26 existing funds adopting sustainable mandates. The allocation of assets to ESG vehicles has been significant, and some analyses suggest that ESG assets could represent a third of global assets under management by 2025. When investor demand and asset growth increase at these rates and to these levels, the Commission and its staff are bound to notice and respond. And that's what we've seen. As ESG investing has mushroomed in recent years, Commission interest has increased apace. I plan to spend the majority of my time this morning highlighting the recent responses across the SEC to the rise of ESG investing. I intend to move in turn through the Commissioners, proposed rulemaking originating in the Division of Corporation Finance, the role of the Division of Examinations, and finally, the role of my division, the Division of Enforcement. I hope that I convey that this is an area of significant interest and effort at the Commission as we try best to balance our tripartite mission of investor protection, fair and orderly markets, and capital formation. I'd like to start with the Commissioners. As you likely know, when fully staffed, the SEC is composed of 5 Senate-confirmed commissioners. No more than 3 of those commissioners can be from the same political party. And since January 2020, 7 people, including the 4 currently serving, have been commissioners at the SEC. And this is the part that really surprised me as I prepared for today's remarks. By my rough count, a commissioner has spoken publicly on issues more than 40 times since January 2020. And this number doesn't even count statements made at the time of the public company ESG rulemaking that came out last month. And it remains a hot topic. Chair Gensler spoke on ESG issues barely a week ago. In light of the volume and diversity of views of the commissioners with respect to ESG, it would be inappropriate and probably impossible in the time that I have today for me to attempt to summarize the varied statements they've made on these issues. But I think it's sufficient to say that ESG issues have drawn substantial attention at the very top of the SEC. And probably the most visible and discussed example of the Commission's interest in climate and ESG issues is the public company reporting rules proposed in March that are intended to enhance and standardize climate-related disclosures for investors. As with all rule proposals that come out of the SEC, the proposing release is detailed and it's long, but I will focus on a few items today. In brief, the proposed rule would require domestic and foreign registrants to include certain climate-related information in their registration statements and periodic reports. Specifically, The proposed rule will require the disclosure of climate-related risks and their actual or likely material impacts on the registrant's business, strategy, and outlook, the registrant's governance of climate-related risks and relevant risk management processes, the registrant's greenhouse gas emissions, which for certain filers and with respect to certain emissions would be subject to assurance, certain climate-related financial statement metrics and related disclosures, and information about climate-related targets and goals and transition plans, if any. At the time of the release, the committee noted that the proposed disclosures are similar to those that many public companies already provide based on broadly accepted disclosure frameworks, such as the Task Force on Climate-Related Financial Disclosures and the Greenhouse Gas Protocol. Drilling down into the required disclosures, the proposed rules would require a registrant to disclose information about things like how any climate-related risks identified by the registrant have had or are likely to have a material impact on its business and consolidated financial statements, how any identified climate-related risks have affected or are likely to affect the registrant's strategy, business model, and outlook, the registrant's processes for identifying, assessing, and managing climate-related risks, and whether any such processes are integrated into the registrant's overall risk management system or processes. And if the registrant has adopted a transition plan as part of its climate-related risk management strategy, the rules would require a description of the plan, including the relevant metrics and targets used to identify and manage any physical or transition risks. The new rules would also require registrants to discuss the impact of climate-related events, such as severe weather events or other natural conditions, and transition activities on the relevant line items of a registrant's consolidated financial statements. For some registrants, there would be a requirement to report direct greenhouse gas emissions and indirect greenhouse gas emissions from purchased electricity or other forms of energy, as well as indirect emissions from upstream and downstream activities in a registrant's value chain, so-called Scope 3 emissions, if material, or if the registrant has set a greenhouse gas emissions target or goal that includes Scope 3 emissions. In addition, if the registrant has set climate-related targets or goals, the proposed rules would require disclosure of this information about the scope of activities and emissions included in the target, the defined time horizon by which the target is intended to be achieved, in any interim targets, how the registrant intends to meet its climate-related targets and goals, and relevant data to indicate whether the registrant is making progress toward meeting the targets or goals. In terms of presentation, the proposed rules would require registrants to provide climate-related disclosure in its registration statement and in Exchange Act required reporting. The rule would also require registrants to electronically tag both narrative and quantitative climate-related disclosures in inline XBRL, and to the extent the registrant is an accelerated or large filer, there was a requirement to obtain an attestation report from an independent attestation service provider covering, at a minimum, Scope 1 and 2 emissions disclosures. The proposed rules also include a phase all registrants with the compliance date dependent on the registrant's filer status, and an additional phase-in period for Scope 3 emissions disclosure, a phase-in period for the assurance requirement and the level of assurance required for relevant filers, a safe harbor for liability for Scope 3 emissions disclosure, an exemption from the Scope 3 emissions disclosure requirements for smaller companies, and forward-looking statement safe harbors pursuant to the Private Securities Litigation Reform Act, to the extent that such proposed disclosures would include forward-looking statements. So, as is clear from the list of proposed requirements that I just ran through, there's a lot to be considered in this proposal. And based on the media coverage and the number of industry, accounting firm, and law firm reactions that we've seen publicly since the rules were released, I can gather that the proposed rules are garnering a great deal of interest. Unfortunately, because this is a proposed rule, I can't really say more except to stay tuned. The rule is out for public now, with a comment period that ends next month on May 20th, 2022. So turning from rulemaking, I want to talk now about the Division of Examinations work with respect to ESG. The Division of Examinations is composed of more than 1,000 examiners for examining, among other things, investment advisors and investment companies registered with the SEC. Exams annually publishes its priorities, and ESG issues have been identified specifically in those priorities going back to 2020. The most recent set of priorities, however, released in late March 2022, demonstrate a heightened focus on ESG issues and note that disclosures regarding portfolio management practices could involve false or misleading statements or omissions, which could result in misinformed investors. So, what are examiners looking for when they're examining for ESG? I think it's helpful to start by saying what they're not looking for. Our examiners are not looking to make judgments on the merits of any particular strategy that an investment advisor may adopt. Rather, examiners are looking to see what advisors say they are doing and comparing that with what they are actually doing. To do this, exams is focused on portfolio management, performance advertisement and marketing, and compliance programs. With respect to portfolio management, exams will review a firm's policies and procedures related to ESG and its use of ESG-related terminology. Exam will also look at due diligence and other processes for selecting, investing, and monitoring investments in view of the firm's disclosed ESG investing approaches. And exams will look at whether proxy voting decision-making processes are consistent with ESG disclosures and marketing materials. Drilling down again, when examining performance advertising and marketing, examiners will review the firm's regulatory filings, websites, and reports to sponsors of global ESG frameworks, and to the extent the firm communicated to clients or potential clients a commitment to follow such frameworks, exams will review client presentations, responses to due diligence questionnaires, requests for proposals, and client or investor-facing documents, including marketing materials. When reviewing compliance programs, examiners will review a firm's written policies and procedures and their implementation, compliance oversight, and review of ESG investing practices and disclosures. To aid firms in understanding what exams is seeing and to promote compliance, exams also, in addition to its priorities, regularly issues risk alerts. In April 2021, examinations published a risk alert related to ESG that included examples of deficient conduct exams had observed. I think these examples are helpful for firms trying to implement ESG effectively. First, exams saw potentially misleading statements regarding ESG investing processes and representations regarding adherence to global ESG frameworks. Second, exams saw issues with compliance policies and procedures. For example, controls that were inadequate to maintain, monitor, and update clients' ESG-related guidelines, mandates, and restrictions. Third, exams identified instances where proxy voting may have been inconsistent with advisor stated approaches. For example, public statements that ESG-related proxy proposals would be independently evaluated internally on a case-by-case basis, while internal guidelines generally did not provide a basis for such a case-by-case analysis. Fourth, exams identified unsubstantiated or otherwise potentially misleading claims regarding ESG approaches. Fifth, exams found inadequate controls to ensure that ESG-related disclosures and marketing were consistent with the firm's practices. Finally, exams found that compliance programs did not adequately address relevant ESG issues in the investment decision-making process. So exams identified a lot of things that were concerns from the examinations that they did of ESG investment strategy. But the risk alert was not just a laundry list of instances where exams found that firms fell short. In an action that I think is particularly helpful, examinations risk alert also shared its observations of effective practices with respect to ESG. First, exams noted that some firms had disclosures that were clear, precise, the firm's specific approaches to ESG investing and that aligned with the firm's actual practices. Second, exams found that some firms had policies and procedures that addressed ESG investing and covered key aspects of the firm's relevant practices. Finally, exams found that some firms' compliance personnel were knowledgeable about their firm's specific ESG-related practices. I think this last point is particularly compelling. It's been our observation that compliance people need to be completely up to speed on ESG investment processes to ensure that policies and procedures that advisors have adopted do match the actual practices of the advisor. While I don't think that the list of deficiencies or the list of effective practices are particularly surprising, I do think that the risk alert gives a good roadmap to developing and implementing an ESG investment approach. Finally, like the rest of the commission, we in enforcement are very focused on ESG issues, both for securities issuers and for market intermediaries. As I mentioned at the top of my remarks, I am a member of Enforcement's Climate and ESG Task Force. And since its creation in March 2021, this group has been focused on issuers' climate-related disclosures and on investment advisors' ESG funds and strategies. Enforcement's focus on ESG issues has also shown up in public statements by high-level enforcement staff and in the Commission's public enforcement actions. For example, last November, Enforcement Director Gurbir Grewal gave a speech addressing, in part, advisors' use of ESG strategies. In his speech, he noted that we're starting to hear claims that enforcement is engaged in regulation by enforcement in the context of ESG. In rebutting those claims, Grewal explained that, as with any investigation, the Enforcement Division looks to make sure current rules and laws are being followed. According to Grewal, in the context of issuers and ESG, this means that the Enforcement Division will apply long-standing principles of materiality and disclosure. And he said, we're starting to see enforcement actions involving ESG in the issuer space. For example, in late 2020, the Commission brought a settled action against Fiat Chrysler for violating the reporting provisions of the federal securities laws by making materially misleading statements about their vehicles' emissions. The order found that Fiat Chrysler had issued a press release and an annual report that both stated that an internal audit confirmed the company's vehicles complied with environmental regulations concerning emissions. But the order found the statements failed to disclose the limited scope of the internal audit and that it was not a comprehensive review of compliance with emissions regulations. Turning to the asset management space, Grewal explained that the division would apply longstanding principles regarding fiduciary duties and honest disclosure regarding how products will be managed. If a manager is marketing an ESG strategy, it must do so in a way that's not materially false or misleading, just as it would in marketing any other strategy. As Grewal's speech suggests, we've long seen commission enforcement actions against firms that do not have adequate policies and procedures in place to ensure that their actual investment approach comports with their disclosures. A recent case provides a bit of a roadmap of how this might look in the ESG space. In February of 2022, the Commission instituted a settled action against Wahed Invest, a New York-based robo-advisor that found various violations of the Investment Advisors Act. According to the order, Wahed Invest marketed itself as providing advisory services compliant with Islamic or Sharia law, including the importance of its income purification process. The order found that despite these representations, Wahed Invest did not have written policies or procedures addressing how it would assure Sharia compliance on an ongoing basis. To me, the lesson of Wahed Invest translates well to the ESG context. If an advisor is marketing itself as having ESG-driven or influenced investment processes, it must adopt policies and procedures reasonably designed to match its marketing to its investment process. Anticipate in terms of future enforcement activity in the ESG space. I think just like in Fiat Chrysler, where we see materially misleading disclosures by public companies, it is reasonable to expect that there could be SEC enforcement action to address those materially misleading disclosures. And in the advisor's context, I think we can anticipate something similar to the Wahed Invest case, where if there are investment advisors that have failed to adopt policies and procedures to map their investment process to their implementations, there could be enforcement actions. And I believe that enforcement actions could go beyond policies and procedures in both contexts, in particular in the advisor's context, if we do find either negligent or intentional misrepresentation of investment strategies, in particular of ESG investment strategies. I could see cases that look like Pax World, or cases that touch on many of the issues in the examination's risk alert. So I want to wrap up to leave time for any questions you may have. But I hope that I've conveyed today that from the commissioners through the rulemaking and examination and enforcement divisions, significant energy across the SEC is being directed to ESG issues. And today's conference is particularly timely given the commission's focus on these issues. The good news is you're at the right conference and you're in the right place. These are the issues that are front of mind for the SEC today. So I appreciate your time and attention. I hope you enjoy the rest of the conference, and I'm happy to try to take any questions you may have.
Thank you very much there, Adam. Well, we have 3 minutes left, so I'll go through questions that I see that have come in and see how we get on getting through the 4 that we have so far, and I look forward to more coming in from the audience. So first one is, does the rule apply to private companies? And if not, do you anticipate certain rules being brought in to apply in the future similar to those you've outlined?
So my understanding is, and I'm not in the rulemaking division, but my understanding is this is a public company rule. I can't comment on any future possible rulemaking with respect to private companies. I will say that all issuers in the US are subject to the anti-fraud regulations. And so if they are making statements about ESG that are misleading or inaccurate, whether public or private, they could be swept into the SEC's orbit. But my understanding of the rule is that it relates to public companies at this time.
All right, thank you, Adam. And next one is, what are examiners looking for when assessing ESG? As much as you can say on this.
Sure. So examiners are not there, and this is a point I want to drive home. Examiners are not there to second guess the strategy, or to second guess the implementation of the strategy. Examiners are there to ensure that representations about the strategy made to investors are consistent with how the strategy is actually being employed. And that's sort of the fundamental basis of both the exam program and the enforcement program, that investors are entitled to clear information such that they can make an informed decision. Okay,
thank you. Are there any interesting open ESG enforcements against investment managers that you can refer to? You did quote a couple I noted there. Are there any others that you would want the audience to be aware of that might help guide them?
So at this time, with respect to advisors, I think the Wahed Invest case that I mentioned, which is not purely ESG, is the best example. I can't comment on anything that might be coming down the pike, but it clearly is an area of interest and across the commission. And typically, when there are areas of interest, enforcement cases follow.
All right, thank you. And very quickly, if you may, do you have any interesting examples against private equity firms or private market asset managers?
So I don't have any that I can discuss publicly, but the same principles that apply to investment advisors to registered funds apply to investment advisors to private equity or venture capital or similar funds. If they are out marketing an ESG strategy, all of the same requirements, assuming that they're a private equity shop large enough to be registered with the SEC, all of the same requirements would apply. And I could foresee cases happening in exactly the same structure.
Wonderful. Well, Adam, thank you very much for your time. We're all very almost out of time. So to our audience, if you'd like to click on back to timeline and then choose to go into the Julie Moretz session, which is next, we'll see you in there for our second session. But to Adam Aderton of the SEC, thank you very much for your time.
Thank you.